With all the uncertainty around SOFI stock, what has become of their 2025 valuation? You see, SOFI's management has come under fire recently for a variety of reasons, and while some of the concerns are actually warranted, there are many things that were brought up that were perhaps a little bit overblown. In the last couple of videos, I actually spoke about my thought process behind some of the things that have happened and some of the concerns I have about their company. Now, my biggest concern still remains with the tech platform. And I do understand the argument that we find ourselves in a fintech winter and many other fintech companies are not doing well at the same time. However, if SOFI's product is really as differentiated as they claim it to be, then emerging out of this fintech winter faster than their competitors has to be key to their growth. And at the moment, we are yet to see that happen. On the other hand, what caused the initial frustration has to do with management's lower than expected EPS guidance in their Q4 2024 earnings. Now, if this was any other company like Google or Nvidia, and management actually came out to tell investors that they are not going to be focusing on short-term profitability, but going to reinvest into the business to drive a long-term sustainable growth, going after a bigger total addressable market, I think any of these companies would have skyrocketed. But this is SOFI we are talking about, and many investors had expectations around the PSUs for management, and because of that there was some misalignment in expectations. But ladies and gentlemen, the fact of the matter is that SOFI actually doubled in 2024, and as investors, what is important for us right now is to understand the numbers behind SOFI's business so that we can determine for ourselves whether or not they have the potential to continue to achieve these lofty targets that they have set for themselves. But as always, potential is a dangerous word, so let's dive in. So I'm going to be breaking this video down into three parts. Firstly, we're going to start by addressing some of the concerns and some of the issues that people have with SOFI by using management's own words. You see, Anthony Noto was actually on CNBC and Bloomberg to address some of the concerns that people have around their earnings, and that will be our starting point. Now, after taking management's words, we'll use this to reassess our assumptions for our valuation model based on the direction that management has provided for us moving into 2025 and beyond. And in the final part of the video, we'll basically run through our valuation based on management's updated projections and hopefully help to give you a high-level understanding of what can be expected from SOFI's business and where the stock could find itself depending on the macro conditions that we find ourselves in. After the most recent Q4 earnings, Anthony Noto actually went on CNBC and Bloomberg to give some interviews where he actually spoke more in depth about SOFI's business than he did on the earnings call. Now, I believe that there are actually 5 things that we have missed during this interview, and I'll leave the link to the entire interview down in the description below, because if I have to play through the entire interview or the different clips of the interview, this video is going to take forever. Now, firstly, I think the general message that Anthony Noto wanted to get across to investors is that their 2025 revenue guidance actually came in 10% higher than expectation despite the lower EPS guidance. Now, if you keep track of SOFI's track records in terms of their revenue guide, on average they have beaten their revenue guidance by around 5 to 6%. And what that means is that we can expect SOFI's revenue for the entire year of 2025 to come in closer to the $3.5 billion mark. Now, it's important to remember this number as we talk about valuations later on. And basically the rationale behind why SOFI is making this move back to focus on revenue growth is that all along their long-term business model has their business operating at a 30% incremental EBITDA margins. Now currently SOFI are operating at a much higher level, around 44% incremental EBITDA margins, and all they are doing is basically reverting back to their original guidance, and they are doing it so that they can capture growth opportunities in underserved addressable markets. And if I have to look at this whole situation, if this was Palantir or Nvidia or even Google, the stock will have absolutely flown, because that is exactly what investors would want management to do, to go after the long-term growth rather than short-term profitability. Now, I think the problem here, like I mentioned earlier on, is that many people got overly fixated on the PSUs and invested because of that, which on hindsight, management could really easily renegotiate some of these terms. So if they do not achieve their PSUs, it's actually perfectly fine. And therefore, SOFI's management chose to go after the long-term sustainable growth rather than chasing after short-term profitability. Now, the second thing he mentioned happened around the 2-minute 20-second mark into the interview. Anthony Noto actually said that the fee-based revenue is up 63% year over year, and this makes up around 40% of SOFI's overall revenue. Now, he basically told us that the focus of the company has shifted, and moving forward, it is this capital-light fee-based revenue that will be SOFI's main growth driver. Now, this is an important issue to keep in mind as we talk about our assumptions regarding SOFI's business later on. Now, the third point that Anthony Noto made during the interview basically cemented the shift in SOFI's business direction, at least in 2025. Now, it's important for all investors who want to understand SOFI's business to understand what has happened over here. Now, around the 3-minute mark, after talking about the fee-based capital-light revenue, right, he basically talked about the tech platform, and these were his exact words. 2026, he said, will be a year of accelerating growth for revenue based on some of the deals we have announced today. Now, initially when I first heard this, I was asking myself, does this mean that we are basically to expect another flat year for the tech platform in 2025? Well, not quite. Because we actually found out that Galileo's product offering today allows SOFI to target a more broad-based revenue stream when it comes to the tech platform. And Anthony Noto's concluding remark in this section over here is something to pay attention to, and this is what he said. The larger financial institutions are moving much slower than we anticipated them to be. With these larger financial institutions, we are fielding many RFPs and performing many proof of concepts, but we don't have to sit around to wait for them to make a decision because we have other areas to drive growth: consumer brands, B2B, and government services. So all is not lost for the tech platform, and depending on how this plays out, we might not get 20% growth in 2025 and 2026, but at least it shouldn't be a single-digit growth like what we just witnessed in the last quarter. Now, the fourth thing that Anthony Noto actually touched on during this interview is his macro outlook, because the interviewer basically asked whether or not SOFI is actually seeing any of the same trends that some of the other financial institutions are seeing, and some of these financial institutions who serve a slightly lower income consumer base, what they actually find out is that savings are running out, consumers are cutting back on spending and basically making only the base payments of credit cards. Now, when Anthony Noto heard about this, he basically said that he read that report, he has seen the numbers, but at the moment the SOFI consumer is still strong. They are not seeing any of such trends at all, which speaks to the quality of the SOFI customers and to the quality of the loans that they originate. So for all the analysts out there saying that SOFI's loans are comparable to some other financial institutions like Lending Club, so these two companies should be valued in the same way, this whole narrative here is painting a completely different story. Finally, when asked what exactly SOFI is investing in, seeing that they have actually projected out a stronger revenue growth but weaker EPS, this was actually a fairly important question, because if SOFI is cutting back on profitability, we want to know that they're able to effectively allocate this capital to generate a good ROI for investors. If not, they might as well just take the money to grow the bottom line. So to this point, Anthony Noto basically reminded us that they're going to effectively keep EBITDA margins flat at around 26 to 27% in 2025, which are very strong levels that they have achieved in 2024. Now, this is probably one of those scenarios that we have seen before with lending previously, where basically SOFI is choosing to operate at this 26 to 27% level rather than actually their business normalizing out at these levels, because their incremental EBITDA margins are over 30%. And so what are the 5 things that SOFI are investing in? And the first one that Anthony Noto spoke about is SOFI Invest. He basically sees this product as having the same level of adoption as SOFI Money eventually. And if you take a look at the 2024 numbers, in 2024, out of the 14.74 million financial services products, 5.1 million was actually SOFI Money, and SOFI Invest actually only made up 2.5 million of all these products, which means SOFI Invest can effectively double from here at a minimum, because as they grow SOFI Invest as a platform, SOFI Money will continue to grow as well. Now, the second thing that SOFI is going to be investing in is their tech platform, as they convert their SOFI Money fully to run on Galileo's core. So because of that, we should see more cost savings, and this will come in the form of increasing contribution margins in financial services. Now, the third thing that SOFI is going to be investing in is to build out their credit card business. Now, we have heard them say this before, but they're being super conservative here once again, and understandably so. But this really has a potential to become a big part of their business if done well. Now, the fourth and fifth thing on this list, which is SOFI Protect, that is their insurance business, as well as small to medium businesses. I view these two things as important aspects of SOFI's business beyond 2026. But in general, if you're talking about purely in 2025 and going into 2026, the aim for SOFI is to be reinvesting 70 cents of every incremental dollar. And now that we have listened to what management has said about the business, I want to talk about some of the assumptions that we have. And if you haven't realized by now, by my nasal voice and my humongously red nose, I'm actually doing this while I am down with a flu. So right now is the time for you to hit the like and subscribe button. Thank you for your time, and back to the video. I think first of all, I do want to challenge the assumption that the tech platform revenue will be the thing that gives SOFI its hybrid multiple. Now, I'm not denying the fact that if SOFI has a fast growing tech platform, it is more likely than not that the market will assign it a hybrid multiple. But what I am challenging is the notion that the tech platform is the only way for them to achieve a hybrid multiple. And I want to come at this from two different angles, and at the end of it, hopefully you will understand why, despite my frustration with the tech platform, I'm still choosing to stay invested. Now, I guess the main assumption that people have over here is that without the tech platform, SOFI will not be able to achieve its hybrid multiple. And it's actually very easy to test that hypothesis, because if that is true, there should be no fintechs out there trading at a hybrid multiple if they do not possess an in-house tech platform. But you can see from this graph over here that is absolutely not true. Every single one of these companies over here is trading at a higher multiple than SOFI, and none of them have a tech platform. When you take a look at it on a price to sales basis, because some of these companies are actually still not profitable, Robinhood is trading at a 20 times price to sales, Upstart trading at a 10 times price to sales, and Affirm is trading at an 8.5 times price to sales, all the while SOFI is just trading under 6 times price to sales. And so the question is, if a tech platform is truly required for a company to achieve a hybrid multiple, how are these other companies trading at a higher multiple than SOFI without one? Which means that the market is actually pricing in something else apart from the tech platform. Therefore, these companies are able to trade at a much higher multiple. And from the way I'm looking at it, the market is assigning a multiple for growth and the potential of future growth carrying on from here. And what is holding SOFI back is actually the perception that they are just a bank. You see, for the longest time, I think people were concerned that SOFI's growth would ultimately be kept by their ability to grow their balance sheet. And many people actually saw the tech platform as a way for them to diversify away from that. In fact, SOFI's management has told us that the tech platform is a way for them to diversify away from that. So the real problem over here is not whether or not SOFI has a tech platform, but what the tech platform actually offers to them in terms of diversifying their sources of revenue. And so what the market actually wants to see is SOFI being able to demonstrate that their revenue growth is not tied entirely to their balance sheet. And I believe that with the introduction of the loan platform business, they're actually doing just that. Because this is actually no different from what Upstart is doing. In fact, in the first 6 months of operating their loan platform business, SOFI is already originating higher quality loans than what Upstart is doing. And Upstart is actually trading at 10 times sales, while SOFI is trading under 6 times sales. So if you were to take Upstart's multiple and apply it to SOFI, it should be easily trading at $25 today. But the truth of the matter is that the perception around SOFI will take time to change, and this is where I agree with many comments that I've read recently that management can do a much better job in communicating this change to the market. In fact, I think whatever Anthony Noto said during the CNBC interview was much better than whatever they presented during the earnings call. But it is exactly this discrepancy between what SOFI's business is actually doing and the market perception around SOFI that gives us potential alpha if we are able to spot all of these inefficiencies in the market. Now, if you actually listen to the most recent earnings call, in fact in Q3 of 2024 as well, the narrative that SOFI's management is pushing has actually changed. Previously, they were pushing the AWS of fintech and their whole tech platform, but today they're actually pushing a capital-light fee-based revenue and reporting that as a percentage of overall revenue, and actually point to that as a growth driver for their companies. companies. You see, ladies and gentlemen, SOFI didn't fail at the tech platform. It is just doing what it has always done, pivoting to the best business model that is best supported by the current macroeconomic conditions. You see, student loans were taken away, SOFI pivoted to do personal loans, and when interest rates increased, they shifted their focus to financial services. And having some time, to sit in my own frustration and to try and understand what management is doing and looking at the tangible evidence in front of me, I see this as another pivot from the management, since the larger financial institutions are moving slower than they anticipated, knowing that they need to provide another source of revenue that is not tied to their balance sheet. SOFI's management moved aggressively to adopt the loan platform business. Now, that doesn't take away from the fact that I still find that their tech platform is fairly underwhelming, and I'm not fully convinced by the AWS or fintech narrative, but my valuation doesn't require that to happen for the investment to make sense to me. But what I've really come to terms with is that to understand the tech platform as just a segment of SOFI's business that makes them a vertically integrated fintech, which ultimately helps them to lower their costs, and they are able to offer this technology out to other companies that generates them another source of revenue. Now, the tech platform doesn't actually need to become the AWS of fintech for it to actually help SOFI's business overall. Because if you look at what happened to Upstart without a diversified revenue source, when the macro environment changes, their revenue was actually hit, while SOFI was able to grow their revenue despite the changes, despite the tough macro environment that they find themselves in, because of their diversified sources of revenue. And so I see the tech platform as just one of their many sources of revenue that they are able to tap on in different macro environments. As we talk about SOFI's valuation, I think that there are three things that we need to keep top of mind. And the first one is that management is right now refocusing on revenue growth for SOFI and re-accelerating revenue growth. Now, because of that, they are going to be operating their business at a 30% incremental EBITDA margins. And in the most recent earnings call, they actually also told us that they are going to be operating the business at a 20% incremental net income margins. And so the assumption going forward for anyone that is doing a valuation on SOFI is that SOFI are going to intentionally be less profitable in order to reinvest this money into other areas of growth. Now, from what I've seen in the comments, I think that there are a lot of new SOFI investors and even some long-time investors that perhaps don't fully grasp the concept of what incremental margins are. They don't understand why management keeps talking about, the fact that they're operating at 30-40% incremental margins, but they keep seeing the EBITDA margins every single quarter come in at around 26-27%. So I'm going to explain this to you quite simply. Now, you imagine if you run a business and in the first year of the business, you generate $100 in revenue. Now, if you are able to keep $20 in profit, we would say that, you have a 20% net income margin. Now, the definition of incremental margin is fairly complex. You can see over here, it's basically saying that, it's basically measuring the change in profitability per unit change in revenue. Now, that's a very complicated wording, so let's simplify this a little bit. What does change in revenue mean? Let's just break it down. Change in revenue. That means that in the first year of the business, earlier on I've mentioned that I've made $100. In the second year of my business, if I bring in $200 in terms of revenue, the change in revenue over here is $100. And so for a company like SOFI to be operating at a 30% incremental margin means that out of this extra $100 that you have made in the second year, you keep $30 as profit. So now I want to put all of these concepts together. In year one, you generated $100 in revenue, and out of the $100, you kept $20 in not profit. So that becomes a 20% net income margin. Now, in the second year, you now generate $200 in revenue. Now, out of this $200 in revenue, the first $100, you keep $20 in profit, and that is a 20% net income margin. But on the second $100, you actually keep $30 in profit, which is a 30% incremental EBITDA margins. Now, if you put these two numbers together on a whole, what you will actually find out is that in the second year of your business, you would have generated $200 in terms of revenue with a net income of $50. And this actually represents a 25% net income margin, which is basically what the formula over here is doing. Right, you're basically taking the second year profit, which is $50, subtracting the first year profit of $20 and dividing this number by the increase in revenue between the second and the first year, and that gives us 30%. Now, if you run this, scenario out into the future, in year 3, what this would mean is that you will have $300 in revenue and an extra $30 in incremental margin. So you have an $80 profit, and this becomes a 26.7% net income margin. You run this scenario out even further into year 4, you will have $400 in revenue and $110 in profit, which represents a 27.5% net income margins. And so what SOFI is basically telling us is that if they follow this formula, if they follow this metric, eventually they're going to reach their 30% EBITDA margins and 20% net income margin goals. Now, if I were to plot this out in a graph, this is SOFI's incremental EBITDA margins and how it looks like over the last couple of quarters. Now, the number that you have heard so far, you have heard management mention this, you have heard me mention this, is that SOFI is operating at a 44% incremental margins. But if you take a look at this graph over here, you don't actually see the number 44%. So how in the world did we get this number 44%? You see, SOFI did not operate at a consistent 44% incremental margins. In fact, if you take a look at the numbers over here, in the first to third quarter of 2024, SOFI was operating at an incremental EBITDA margins of way over 50%, which means for every dollar that SOFI makes more than the previous year, they kept 55 cents, and that is insane levels of profitability. Now, they intentionally dropped this number down to 12% in the fourth quarter of 2024, which brought the entire average down for the whole year to 44%. And this basically shows you the level of control that SOFI's management have over their entire business. I think to them, profitability is just like an on and off switch. They basically pick a level to operate at which they can easily beat the numbers that they have guided for, and yet still continue investing into the business. To give us an idea of how profitable SOFI is, if they chosen to operate in Q4 of 2024 at a 30% incremental margin instead of a 12%, their EPS would have come in anywhere between 7 to 8 cents in the fourth quarter instead of the 5 cents that was their actual result. And by doing that, what SOFI's management has done is to prove to investors and analysts that they can operate at a highly profitable level, but right now they are choosing to turn their focus back to generate revenue growth. And so in this high level assumption over here, we can see that on average, SOFI beats their revenue by around 5 to 6%. Now this is where I already have an asterisk over their valuation, because in the earnings call, they said that they are likely to beat their 23 to 26% revenue guidance, and in the first quarter of 2025, they actually guided for a 25 to 28% revenue growth. So that means in order for them to reach this 23 to 26% revenue growth, they are basically projecting a slowdown in revenue across 2025 in a year where the narrative is supposedly growing their revenue. And I get it, they're conservative because nobody understands the impact that Trump's policies are going to have, but like I said, the numbers are just not making sense, so we have to dig a little bit deeper. If I were to go a step further and use the segment assumptions that SOFI has given to us during their earnings call, they have basically guided for their lending revenue to come in around the mid-teens, but they have already done 22% year-over-year growth in the fourth quarter of 2024. And I don't really believe that will actually slow down unless it is intentional, which doesn't make much sense because they're trying to grow revenue. But conservatively, we're still assuming a 17% year-over-year growth in the first 2 quarters of 2025, a 20% growth year-over-year in the third and fourth quarter of 2025. Now, in terms of financial services, that is quite straightforward, right? They basically guided for 65% year-over-year growth, and we are just going to be assuming that 65% year-over-year growth stays stable throughout the entire year. Now, for the tech platform, SOFI actually guided for low to mid double-digit teens growth, but what I'm assuming is actually a more high single-digit, perhaps towards the end of the year, a little bit more double-digit type of growth, because Anthony Noto has already said that most of the revenue recognized based on the clients that they have signed in 2025 will only be seen in 2026. And yes, they could definitely onboard other clients during this period of time, but how significant it is to their entire revenue remains to be seen. So I don't actually touch the overall revenue number just by looking at the segment numbers and using the guidance that management has given to us. We actually come in with a full year revenue of around $3.5 billion, and that would actually represent a 7% beat in revenue, which is more or less in the ballpark of what we would expect SOFI to do. However, by beating their revenue by this 7%, this is actually something that they have done in the last couple of quarters when they were actually not focusing on revenue growth. But moving ahead, if SOFI's management is turning their focus on re-accelerating revenue growth, then perhaps we can expect the beat in revenue to actually be a little bit more than that. So this is something that we do have to pay attention to. Now, if you take a look at the incremental margins, if they are operating at a 30% incremental EBITDA margins, for the full year, EBITDA would have come in at $931 million. This is an 8% beat, which is still lower than what it was previously, but more or less in line with what we have seen in the past year. And as this EBITDA number gets bigger and bigger, it's only normal that the beat gets a little bit smaller. Now, if they are operating their business at a 20% incremental net income margins, then we get to an EPS of around 29 cents at the end of the year, which is above their high end of the guidance of 27 cents. And all of this assume that, SOFI actually does this by meeting the expectations they have given to us and not beating the expectations. But we do know, based on their track record, that SOFI is a company that tends to beat their own expectations. And it's all these small little tweaks within their business that can bring this EPS number up. So let's adjust some of the assumptions from here and see how it affects SOFI's profitability. So when it comes to the lending segment, instead of assuming 17% year-over-year growth and accelerating to 20% towards the end of the year, we are basically going to assume a 22% year-over-year growth. This is the same growth rate that we have had in the fourth quarter of 2024, but this growth rate never accelerates throughout the entirety of 2025. Now, in terms of financial services, let's assume that they will beat their own guidance by 2%, so coming in at 67% year-over-year growth, just a slight beat. And in terms of their tech platform, we're going to be assuming that grows around a 10 to 11% range, low double digits instead of single digit growth. Now, after understanding some of the assumptions that we have made to SOFI's individual segments, I want us to pay a little bit of attention to SOFI's incremental net income margins. Now, historically, this has been operating above 30% despite their guidance of operating at 20%, except last quarter. And there are also two other quarters historically where that did not happen, but those are due to one-time events. But let's just assume that instead of operating at the bare minimum of 20% EBITDA margins, they just operate their business at a 22% EBITDA margins, and that will bring us to an EPS of 32 cents at the end of 2025. And what that means, if you take the sector average PE ratio of 70 times PE and apply it to this 32 cents, you get a price of $22.40, which represents a 49% upside from prices today. But if you go a step further and value SOFI based on Upstart's valuation on a price to sales basis, understanding that they both have similar business model, then at 10 times price to sales, SOFI's market cap should be around $35 billion. And with around 1.2 billion shares outstanding, that should put SOFI's price target at around $28.50. Now, if you put these two numbers together, what you actually get is a very nice average of $25. From today's prices, that's a nearly 70% return in a year. Now, I don't know about you, but to me, that's a rather decent return. I think a lot of us over the last couple of years have gotten used to crazy returns in the market, especially due to the crypto market. But I think we forget the power of basic compounding. Now, SOFI has more than doubled in 2024, and it grew another 70% in 2025. And to me, that is still a fantastic return. That means for every $100 you put into SOFI, that could potentially grow up to $340. Now, if that happens, that would mean that you double your money in 2024, grew another 70% in 2025, and basically 3.4x your money in the span of 2 years. So at the end of the day, I think the question really facing investors is, do you think these assumptions that we have talked about is conservative, or are they unachievable for SOFI? Now, if you do think that these assumptions are conservative and they are achievable by SOFI, then the next question is, are the potential returns, if you assume average market conditions, enough for you? Because these price targets are not a certainty. For all we know, SOFI could continue to execute and still not be rewarded by that hybrid multiple. So nobody can make that decision except for you. But the fact of the matter is that SOFI is a company that tends to beat its own expectations, and to model that out into our valuation, we have to understand what are the levers this company can pull in order to do that, and to understand how they can beat expectations moving forward and not just slap a number onto a spreadsheet and find out their valuation. So that is what we have to do next for SOFI. But before that, there are two companies that I want to talk about. One that has been absolutely beaten down and another one that is up over 73% year to date, both of which presents a decent opportunity in the long term, and I talk about them in this video over here. Now, I know I also said a live stream is going to be soon, but the Lunar New Year holidays were more hectic than expected. I'm also done with the flu and I'm learning to set everything up, so I'll hopefully see you live really soon, but more importantly, I'll see you in the next one.